You've probably seen a ton of videos promising how to turn $100 into $1 million trading stocks or the secret to getting rich overnight. Unfortunately, all of that is garbage, because if getting rich was that easy, everybody would be sipping margaritas on a yacht right now, right? Here's what we're going to cover in this video. We'll start with inflation, then whether you're investing or gambling, how to handle market crashes, two types of investors, the 25-75 rule, margin of safety, and why investing in IPOs is a terrible idea. The only strategy that has consistently worked isn't about chasing trends. It's about real investing. I'll show you exactly how to do it using simple, straightforward, old and gold traditional strategies that build real wealth. Hi, my name is Rizan. I'm a Big Four qualified chartered accountant and I'm an ex-financial consultant at the Big Four firms in London. So on this channel, I usually talk about finance, small businesses, tax strategies, practical money-making tips, investments, and lots more. So let's dive straight into a topic. The number one silent wealth killer is inflation. So making money in stocks is one thing, keeping it is another. One of the biggest threats to your wealth isn't just bad investments, it's inflation. Inflation slowly eats away your purchasing power. What you buy today is going to cost much more into the future. And here's the mistake most investors make. They think holding cash is safe, but in reality, holding cash guarantees you're losing money. That is why long-term investors must put all their money in assets that basically outpace inflation, like stocks, real estate, and inflation-protected bonds. It's not just about making money, it's about making sure that your money still holds the value decades from now on. Now, let's talk about a major mistake where we confuse real investing with gambling. So are you investing or gambling? Let's be real, most people in the stock market aren't really investors, they are gamblers. Ask yourself this, when you buy a stock, is this because you've actually looked into the company? Do you know what it does, how it makes money, and why it's still gonna be successful years from now? Or you're buying just because somebody said, wow, this stock is going up, let's buy. Always remember, investors buy businesses and speculators chase hype, and here's where most people get it wrong. They think they're investors, but in reality, they're just chasing prices. Maybe you're thinking, come on, I know what I'm doing. I can outsmart the market. Even Sir Isaac Newton, one of the history's smartest men, got greedy and lost $3 million in today's money trying to time the market in the famous South Sea Company scandal. Proof that even the smartest people cannot outthink the market. So before you place your next trade, stop and ask yourself, are you truly investing or are you just rolling the dice? Here's where it gets even more interesting. The stock market itself behaves like an emotional, unpredictable business partner, one who consistently overreacts. But if you understand this, you can actually use it to your advantage. Let me explain this. Let's talk about market crashes. Prices swing wildly not because businesses change overnight, but because investors are emotional people. Some days people are overly optimistic, bidding up stock prices way beyond their actual value, and other days fear takes over and great companies get dumped for no logical reason at all. So most people panic when market drops, but smart investors, they see opportunity. For instance, if you invested $1,000 in S&P 500 in 1970s and just left it alone, it would be worth $200 today. That's why the key to investing isn't predicting what's going to happen tomorrow. It's staying rational when the rest of the lot is losing their minds. So the next time the market drops and your instincts tell you to panic, remember this, market crashes do not destroy wealth. Panic does. When it comes to investing, there are two types of people, and which one you choose to be makes all the difference. First is the defensive investor. This person wants steady, reliable growth with minimal effort. They invest in strong, established companies or simple, low-cost index funds, and then they sit back and let the time do the magic. Second is the enterprising investor. This person is willing to put in the time, effort, and research to find the undervalued stocks, ones that the market has temporarily mispriced. They don't follow the crowd, they think independently and make decisions based on their deep analysis. Now here is where most people screw up. Most think they're enterprising investors when in reality they're just reckless speculators. They convince themselves they're doing research when in reality they're just watching a few YouTube videos and reading stock tips on Twitter. But here's the truth. If you don't have time to study company financials, read earning reports, and analyze market trends, you're really better off as a defensive investor. And guess what? Most defensive investors actually beat the so-called stock pickers over the long run. Take Warren Buffett. Despite being one of the greatest stock pickers of all time, he's repeatedly told 99% of people to just invest in low-cost indexed funds and then leave it alone. Why? Because history has shown that trying to beat the market usually backfires. Now, over the past 20 years, most professional fund managers, people who get paid millions to pick stocks, have actually underperformed the market. So here's the big takeaway. You don't need to be a genius to invest successfully. You just need to be honest with yourself about what kind of investor do you want to be. And if you're willing to put in the work, be disciplined, and stay unemotional, go for it. Be an enterprising investor. But if you just want strong, steady returns without the stress, stick to the index funds, invest consistently, and let compound interest do the heavy lifting. Now let's talk about the 25-75 rule, the smartest way to split your investments. One of the greatest investors of all time, Benjamin Graham, had a simple but very powerful rule. A smart portfolio balances stocks and bonds between 25 and 75%, adjusting with market conditions. When stocks are overpriced, shift towards bonds for safety. And when they're undervalued, increase your stock holdings. But most people do the opposite. They buy really high and then panic and then sell low. Smart investors let the value and not emotions guide their decision making. This strategy stops you from getting wiped out in crashes while still letting you profit from recoveries. So instead of doing the guesswork, follow 25-75 rule and let market conditions, not emotions, guide your decisions. Now let's talk about one of the biggest traps that suck people in, IPOs. And why? More often than not, they're a very terrible deal for you. Why IPOs are a trap and why you should ignore them altogether. So let me guess, you've heard the hype before. This is the next big thing. Get in the IPO before it's too late and whatnot. Sounds really exciting, right? But so was Pets.com, WeWork, and every other overhyped IPO disaster. The question is, why do people still fall for it? Well, because IPOs play on your emotions. Simple. The fear of missing out, the excitement of something new, and the dream of getting rich overnight. But let me ask you this. If an IPO is such an incredible opportunity, why are they aggressively selling it to you? I mean, ever seen an ad saying, come and buy Apple stock today? No, exactly. Those great companies don't need to convince you to buy their stock. So the next time you hear the hype, just remember, if something is being sold to you as a once-in-a-lifetime opportunity, it probably isn't. IPOs should really stand for it's probably overpriced. Now let's talk about the single most important rule in investing, one that can save you from making costly mistakes. The golden rule of investing is the margin of safety. And here's something most people get wrong about investing. It's not about making most money. It's about not losing your money. And it sounds really weird, right? But the best investors don't focus on hitting home runs. They focus on avoiding disasters. And that's where the margin of safety comes in, the single most important rule in investing. So what is this margin of safety? Think about it like this. Imagine your car fuel tank can last, say, 400 miles and your destination is 399 miles away. Would you risk it without refueling? Probably not. You're gonna leave a buffer, right? Just in case. Same with investing. You don't buy a stock at its full price hoping everything's gonna go perfectly. You buy it below its real worth, so even if things go south, you still come out ahead. And that is the reason why Warren Buffett, who built his $100 billion fortune using this principle, said the three most important words in investing are margin of safety. Why? Because this rule saves you from stupid mistakes. But here's the problem. Most people invest based on hype, hope, and gut feelings. They fall in love with a stock, convincing themselves it's the next big thing and ignore the price, justifying it with something like it's a great company and it must be really worth it. But the thing is, a great company at a bad price is still a bad investment, and history has proven this over and over and over again. In 2000s, people were paying 100 times the earnings for the tech stocks because internet was the future. In 2021, people did the same thing with hype stocks, believing stocks only go up. And every time those overpriced stocks came crashing down, they wiped out people who ignored margin of safety. So how do you actually use this rule without being a math nerd? You don't need to be a financial wizard to follow this. Here's a simple rule of thumb. Don't overpay. If a stock is priced for perfection, it's probably a very bad deal. Look for discounts. The best investments happen when great companies are temporarily undervalued. And number 3, be patient. If a stock is too expensive, just wait. Sooner or later, the market gives you a way better entry point. So investment isn't about being the smartest person in the room. It's about being the most disciplined. So the next time you're about to buy a stock, stop and ask yourself, am I leaving myself a margin of safety, or am I just hoping for the best? Now let's wrap this up with the 3 biggest takeaways from everything we've covered today. I know we've covered a lot, but the key takeaway is invest with discipline, ignore the noise, let time do the heavy lifting, and that's how real wealth is built. So if you found this content helpful, make sure to give it a thumbs up and subscribe to my channel if you haven't already, and I will see you in the next video.